Hello and welcome to the CIO market update. We have a bit of a different setting today, but the topics are still the same. I'm going to talk about the economic outlook, about inflation, about monetary policy, and of course about financial markets. Actually, if I had to answer just one question today, it would be, have markets priced in the recession already? I think that is the most prominent question right now. Markets are discussing, analysts are analyzing, and of course we are also looking at. Well, to be precise, of course, I won't be able to provide you a definitive answer to that question, but of course I'm happy to share with you our view on the economy, on inflation, on financial markets, and how we would answer that question as of today, and what that answer will mean for the portfolio. My name is Felix Prill. I'm the Chief Investment Officer of VP Bank. Well, and as usual, if you have any question, please feel free to answer them. You have a chat function for that. I will see your questions then on the tablet here, and will answer them after my introductory remarks. Now, looking into markets, what happened so far this year, it shouldn't be a big surprise for you. It has been a really tough, really challenging year, 2022 so far. If you look, for instance, at the stock market returns as of end of October, it's really a tough year. You see that on the chart here for the US stocks, and not just for the last couple of years, but actually for almost 100 years since 1928, the annual returns. And you see that this year is indeed a very negative one, but interestingly, it's not the most negative one as of today. We've seen quite some more negative years, for instance, during the financial crisis, and where we have, within a year, had a drawdown of around 40%. So we are not there yet. Maybe we get there. We will discuss that later. But what's actually interesting is, if we not just look at stock markets, if you look at the rest of the financial markets as well, and you look for as a representation of that on a balanced portfolio consisting of 50% Swiss stocks and 50% Swiss bonds, because we have so much data for that very long, also for the last 100 years. You see also ranked by the worst performing year up to the best year from the left to right. The picture is actually a bit more pronounced. You see that this year so far has been the third most negative year, with a decline of around 15%. Of course, it depends on what day you're looking at. Only 2 years in the past 100 years with a more negative result was in the financial crisis, because of the strong decline in stocks, and in 1974 when we had the first oil price shock, and back then the similar situation took place as this year. We have seen back then a strong increase in yields. So kind of this chart shows it is indeed really a tough year. There was not really a place to hide in financial markets. Bonds are down, equities are down, and many other asset classes are down as well. Now, the reason for that actually is very much linked so far to interest rates. And this you can show on like this chart shows that in a simple way. What you see on the chart is the dark blue line is the 10-year Treasury bond yield inverted. So basically it moved up, obviously, to around 4%. We show it like the vice versa here. In order to make it comparable to the stock market returns at the S&P 500, that's one line, and it is the golden line, and the light blue line, it's the valuation of US stocks. And it's actually interesting, it's moving very much in parallel. So what you can basically conclude from that chart is, of course, it's a simple analysis, but what you can conclude is that most of that stock market decline so far is stemming from the increase in yield. And this shouldn't be such a big surprise, because the price of a company, the stock price of a company, is very much dependent on the interest rate, because how you get to a valuation of a company is that you discount all future earnings by the current discount rate. Now, if that discount rate goes up dramatically, that will mean that your the valuation of the future earnings come down. And that's basically what we've seen so far this year. We've seen such a strong increase in yields, a strong negative impact on the valuation of companies. And it kind of, in that simple analysis, explains most of it. But in that EPS, the valuation, earnings per share, there's also something we call earnings, right? We have to have an assumption on the future earnings, not only on a discount rate. So coming back to my original question in the introduction, have markets priced in everything? Well, that's the crucial question right now. What about the P? What about the profits? Is there everything already in there? From that chart alone, we have maybe some doubts because you can explain mostly everything to interest rates. Now, but to get a bit more into detail, to try to answer that P question, is everything already in the profits of reflected? The recession topic, is it already in the numbers, in the market expectations of analysts? Well, for that, I have our current, some input on our view on where we stand in the economy on markets. Now, if you start on the economic environment, it's still challenging. If you look at that chart, for instance, you see the expectations for the spending of US consumers for the upcoming Christmas shopping season compared to the previous year, to the last season. And you see it's basically everywhere, it's a negative sign there. It's -10 to up to -30, 35%. Of course, very obviously and very easy to understand that in luxury goods you cut down your expected spending most. It's the most you can avoid, basically. You don't have to have luxury goods. Usually, some people might still need some luxury goods, of course. It's a different topic if you think about, toys and so on for children. Of course, you have to cut back maybe as well because of the high inflation, but not as much, of course, as on luxury goods. But the message here is the recession, or coming from that strong increase in inflation, I come to that in a minute, is really eroding purchasing power, and it's not over yet. So we will see more negative impact from there. We've seen leading indicators, of course, deteriorating quite a bit, signaling that recession. And in our view, it's too early to call the end of the recession. It's still unfolding. And so that is a challenge. And that is a challenge for the earnings expectation. Having said that, there are also some positive news. And they're starting to become more and more in recent weeks. So, for instance, we see that supply chain issues are no longer as prominent. Our supply chain index that we have been calculating now for many months, is really improving, indicating basically that the situation for companies is getting better. So they can deliver their orders and so on and so forth. That helps. What also helps is that we see, if you look at Europe, that the fear of a blackout in that energy crisis is materializing, that fear is kind of now more limited because we've seen the support by governments, that they have these energy price ceilings, and we see also that energy prices corrected to some extent, so that gives a bit more visibility for companies and consumers on their energy bill. And on top of that, we see a bit of an easing of pressure in inflation. We see that namely here, if we look at the US picture and US inflation rate, last week we've seen a pronounced decrease finally after, it was not the first decline in the annual inflation rate, but it was the most pronounced so far, dropping from 8.2 to 7.7% annual inflation. It's still very high, but the good message here is it is the right direction. It's gaining traction basically. And if you look at some of early indicators, for instance, what I put on that chart is a survey among small companies in the US about their plans on price setting for the next 3 months. And this indicates clearly less price increases or actually even falling prices. In the past, this has been a very, very good indicator for the outlook for inflation, and this indicates clearly now that inflation rates, annual inflation rates, will come down substantially, and they will come down fast in the next couple of months. It's a really good message. It does not mean that like the purchasing power is getting back into the pockets of consumers, but it's not deteriorating any further, and that is a very important message. And this is also for financial markets a very important message, because this will finally give the central banks more room to maneuver. The Federal Reserve stressed really the message that inflation is still key priority number one. If we see finally that easing of inflationary pressure, this would give the Fed more room to maneuver, to no longer increase rates at the same speed or even stop increasing interest rates. So we expect for the December meeting only an increase of 50 basis points, no longer of 75, and maybe 1 or 2 more increases early next year. But as of today, if inflation is really moderating as expected, this would open the window for the Fed to pause at least with their inflation hikes, and this would be very positive for financial markets. If you look at other central banks, they're lagging a bit behind, especially Europe. So we need a bit more there, but also there at some point we see that positive probably message as we see it with the Fed. This, on the other hand, then means that the outlook for bonds has definitely improved. We've seen a strong increase in yields, which was negative for bondholders, of course. But now at the current level, if you look at 10-year Treasury yields of around 4%, in Germany around 2%, in Switzerland around 1%. Easy to remember 1, 2, 4, right? So that is much more interesting entry level now than compared to a year ago. So you're getting now finally again compensated for your interest rate risk for holding that bond, for a compensation for, to some extent at least, for inflation. And if the recession worries gain momentum, if that was the case, then typically bond yields would come down, and that would also support then the portfolio. So therefore, we are in the Swiss franc, in the euro portfolios, we are neutrally positioned on bonds. We used to be quite underweight this year, which was positive from a tactical point of view. Now we are neutral, and for US portfolios, actually we are overweight bonds because of the higher yield we have already in bonds. So fixed income, finally, again, an asset class to invest in. It's more interesting, it's an alternative, and we're getting more and more opportunities to selectively invest also in fixed income. This is not yet the case for stocks. We have seen a bit of a rebound in the last couple of weeks. We've seen a strong market reaction last week on the inflation data in the US, a bit too strong in our view. Because, and coming back again to the earnings expectations of the profits of companies, if we look at the earnings expectations, they are still, in our view, quite optimistic. In the US, we have seen a bit of a slowdown, lower earnings expectations, but not at all a recession. And in our view, a recession is still the most likely scenario. So we have to expect more negative impact from earnings expectations. And there's, of course, in that environment currently, we are still facing some risks. We have uncertainty on inflation still, even though the messages, the signals are positive. There's no guarantee that it's gonna happen. We have uncertainty on central banks. We have uncertainty on the war in Ukraine, and so on and so forth. So in that environment, we think it's still the way to go, not to chase each and every rebound, to be more defensive, to be a bit more cautious, and therefore we remain underweight in stocks. The outlook starts to improve, but we are not there yet to go neutral in our view or go overweight already. We're of course monitoring that closely, but we would remain underweight as of today, especially given the recent market rebound. So from a portfolio point of view, our stance is stay defensive, stay cautious with regard to equities, be neutral on bonds, or even overweight on US bonds in a US portfolio, be overweight on cash and alternatives still, in order to be as robust as possible in a portfolio. So basically, the question asked in the beginning, is the recession priced into markets? No, in our view, it's not fully priced in. So praise for maybe in the short term a bit more negative impact again, therefore stay cautiously positioned. With that, thank you already for joining in. Now I would like to open the floor for any questions from your side. Looking now at the tablet and see that 2 questions already came in. So the first one, okay, I tried to avoid it. No, just kidding. What's the outlook for the US dollar and the euro? Of course, currency is a very important topic right now. We've seen quite a market reaction in the dollar, a weakening of the dollar for a change. The dollar has been really the stronghold so far this year, up more in between like something like 15% against the euro. Now we've seen a bit of a reversal of that, clearly indicating that it's a bit more risk-on environment in markets. We have seen a bit of from a technical point of view, it was a bit overbought, the dollar, had some indications there from the positioning. So that is kind of a reaction to that. Is this continue at the same speed? Most likely not, but we would be skeptical on the dollar outlook for the next couple of weeks and months. Of course, if we see a bit more risk aversion return to markets, that would strengthen the dollar, but we see more upside potential on the euro against the dollar, definitely. And if you look then at a dollar Swiss franc, that in line would also probably mean that the dollar is weakening against the Swiss franc. So that's our view. And in general, from a euro and a Swiss franc perspective, for instance, we would hedge clearly the dollar. Then another question, what's your view on high yield? A very good question. I mentioned that we see more opportunities on arising basically in fixed income, and high yield could be a very interesting one. Like if you look at high yield, of course, we have 2 components. We have the underlying risk-free rate. Like, let's take the government bond yields. Of course, that increase in yields hurt high-yield bonds also quite a bit. But now, of course, we have a bigger buffer. We have at a higher level. But the second component is, and that's typically the more important one for high yield, is the credit component, so the credit spread. You've seen a widening there, but it's not a widening that is typical for a recession. Also here, we don't see a recession fully priced in high yield. Of course, at first sight, if you look, like depending on which segment you're looking at, a yield of, like 8, 9%, 7, 8, 9%, it starts to look interesting from that point of view. But it doesn't look so interesting if you just look at the credit spread. So we would expect, the chances are high in our view that we see a bit more of a spread widening again. So and then this would for us be the entry point to get more exposure on high yield. Look at it, but be still like opportunistic. For the time being, we favor high quality bonds, government bonds, or high quality corporate bonds versus high yield bonds. So just glancing at the question, no question to Bitcoin. What a surprise. I hope you're enjoying the ride there. Thanks again, really, for taking the time for dialing in. I'm looking forward to talk to you soon, in person or in that way. You see me, I don't see you, but that's not the worst thing probably. With that, stay safe, enjoy the rest of the day, have a successful day. Talk to you soon. Bye.